Welcome to Agilis Capitis. I hope you're having a great Christmas and New Year with a restful break ready to kick off 2022. Standard disclaimer, of course, you should always remember that this is not financial advice, either general or specific in nature. It does not consider your specific financial circumstances, and as always, you should always do your own research. At Agilis Capitis, the key to successful long-term market outperformance is to identify and capitalise on investment opportunities that will be affected by change. The objective is to generate positive returns no matter if the market is going up or down. This is achieved by identifying market trends and specific securities that will be affected either positively or negatively. The objective is to seek out and capitalise on either under or overvalued investment opportunities, holding either long positions if the security is expected to go up in price, or to short it if it is overvalued. Other than focusing on ASX stocks, the investment strategy of Agilis Capitis is not limited to any specific sector or size, providing complete flexibility. But one thing is for sure, if we can't find good investments, we are not afraid to hold cash. We are at an historical point in the market, with extraordinary evidence of speculative behaviour. We are 12 years into a bull market driven by falling interest rates to historically low levels that are starting their ascent from the basement. Global governments' emergency fiscal and monetary stimulus driven by the COVID pandemic has extended the current bull market that initially was peaking in 2019. This has facilitated one last broad-based push higher in asset prices, or what the technical traders would call a blow-off. Disruptive and constrained supply chains are struggling to keep pace with rapidly rebounding demand. Further, economic stimulus packages and tight labour markets are feeding into inflation not seen in decades. Although inflation was initially thought to be transitory as a result of the impact of the reopening, it is becoming more structural. In the past year, higher inflation has cemented itself as one hallmark of the post-pandemic recovery, and this will require a policy response. Rising global interest rates will bring to an end this bull market, putting pressure on the sustainability of the long-term uptrend in asset prices. Smaller economies have already been raising interest rates this past year, while the larger ones are at different points in the cycle. The Bank of England was the first Group of 7 member to increase interest rates, following the lead of central banks of less developed nations. And the BOE is targeting 4 rate rises in 2022. The Fed has become more hawkish about accelerating the pace of the reversal of its emergency policy settings. The ECB is holding fire as current indicators are not conducive to raising rates, while the RBA is also holding off and is forecast to make a move in late 23 to early 24, although the market does not believe it. But it does warrant the question, what happens if we're tightening while the rest of the world is starting to loosen and our key commodities are not firing? Makes you think. However, the other end of the spectrum, China is loosening policy settings and is expected to implement more growth initiatives. With global interest rates rising, withdrawal of fiscal support, rising inflation, these are likely to weigh on growth rates, putting pressure on that long-term bull market. It is now a matter of where to from here and how to position the portfolio to benefit next year. We take this opportunity to assess the key themes expecting to impact our core markets next year. Although the reopening process continues to be disruptive, 2022 should see a continuation of the pandemic healing process, which is less daunting than what we've already experienced. Both New South Wales and Victoria will drive short-term growth as they recover from lockdowns. With the remaining states having been relatively insulated over the year, they are not expected to contribute to the same degree. Business investment, as well as government spending, will also be growth drivers in 2022. Notably, the New South Wales state government is embarking on a wave of new transport infrastructure projects. Tourism will benefit as borders reopen, initially from interstate travel and eventually international travel once disruptions ease. As Australia did not experience the mass loss of workforce compared to the US and Europe, as well as Europe's energy crisis, this is not feeding into wage pressures and inflation like has been seen overseas. However, supply constraints and inflation are global issues, which is becoming structural in nature. It will have a flow-on impact, particularly with constrained spare capacity in labour markets. The RBA has made it clear that it needs to see full employment levels of about 4%, broad-based rising wages of about 3%, and inflation consistently within the 2 to 3% band before it considers increasing interest rates, with rates expected to start increasing in mid to late 23. This is notwithstanding that the bond market sees it differently, with expectations of rates moving by July 22. This tightening cycle is not expected to see rates increase significantly. With the amount of leverage in the market, it will not take much to create a dampening impact on growth and asset values. Further, a removal of global fiscal stimulus will occur at the same time that interest rates are increasing, amplifying the impact. Aussie growth rates are expected to peak in 22 as households spend the savings they've built up over the last 12 to 18 months from government support and reduced ability to spend. There is only so many TVs you can buy, and renovations have slowed down. The key sectors of materials, energy and financials have benefited from the bounce back in economic activity, but a potentially further tightening in fiscal conditions is expected to limit further upside. However, this year might still see some good dividend payouts supporting share prices. However, there is little catalyst for further large gains in equities, particularly during 2022 after its strong long-term run. However, one thing is for certain, that this rising interest rates, the value of bond proxies investments will be under pressure, as well as those investments that have an elongated period of time before generating income. This will see a greater rotation from growth stocks to value in the short term. Over the past year, China has been tightening monetary policy, which has moderated growth. Add to this the vulnerabilities, including its dependence on foreign sources of energy, including rationing, has seen a mandated reduction in production levels at the same time that COVID-induced snap lockdowns have reduced supply and increased the risk around stronger and more persistent inflation. Despite the heavy-handed approach, the economy has continued to show strong underlying momentum. Add to this the significant regulatory change that was implemented to reduce leverage and speculation in the old growth sectors of residential construction and infrastructure investment. This will continue to have a short-term impact on housing supply and demand as well as growth. Further, the government implemented policies to protect against the loss of control of technology and information, penalising companies seeking globalisation. This resulted in a flight of capital from Chinese companies and in some cases throwing the baby out with the bathwater. While disruptive in the short term, the objective is to skew investment towards long-term, income-rich opportunities and a localisation of consumption, with the further objective of reducing income inequality and deal with pressing social issues and risks to the banking system, particularly from property speculation. With a significant amount of personal wealth tied up in property, China is working on an orderly workout of over-leveraged developers like Evergrande, Fantasia and many others. Further, as growth is peaking, Beijing is focusing its attention on more accommodative policies. This includes the focus and growth of capacity of industries that deliver to both the local and international markets, advanced manufacturing, emissions reduction and green projects. This includes services, particularly tourism and education, but also industrial goods and technologically focused industries. As China grows its wealth, particularly having a savings rate that is double that of Western economies, the objective is now to be exposed to consumption in China compared to historically being exposed to investment. A longer term process is to change Chinese consumption habits to buy local brands and are more able to expand internationally. Localised income growth will in time also support additional investment in the old guard industries of residential and infrastructure and construction as consumers expand their lifestyles and cities develop to accommodate. The construction pipeline will have longevity, being founded on recurring income from trade as opposed to speculative borrowing by government authorities and households. Ongoing growth of 5.5 to 6% is therefore certainly achievable. Further easing will include cuts to the reserve requirement ratio and potentially a reduction in policy interest rates, as the ongoing property slowdown will likely continue to drag on growth next year. Authorities also signalled more fiscal support early next year to drive investment in infrastructure. In the short term, once government relaxes energy-intensive industries restrictions and its blue sky policy for the Winter Olympics, this will allow for a reopening of production in those industries and assist with the current supply side issues facing the global economy. Notwithstanding the disruption and uncertainty arising from the Omicron variant of COVID, in the last 3 months, the US economy has experienced 2 significant changes. Firstly, momentum lost in Q3 has been regained with rebounding consumption and robust investment pointing to stronger growth. And secondly, actual inflation levels and expectations are at multi-decade highs. Recent prints for US unemployment and underemployment point to little available slack and within reach of pre-pandemic levels. Meanwhile, momentum in employment growth and the outright level of job openings remains elevated, with full employment expected to be reached by 2022. The consequence has been a strong bid for wages, albeit unequally across the economy, with a risk that labour demand outstrips supply while participation remains weak, putting pressure on wages. Inflation is currently running at rates not experienced for nearly 4 decades. Although some of this inflation has risen due to strong demand from a reopening economy, there is a significant risk that inflation will become structural, particularly if wage pressures feed into future inflation. While at the same time Biden is seeking to implement the Build Back Better infrastructure spending plan to add to growth, but may further add to inflation. With growth rates at or above trend, meaningful inflation risks, and a tight labour market, this will accelerate the Fed's pace of the reversal of emergency settings, with tapering likely to last until March and then 3 interest rate rises during 2022 commencing in June. This is then expected to be followed with a further 3 hikes by June 2024. At the end of 2021, Europe finds itself at a challenging point in their pandemic recovery. Labour markets across the region have improved considerably following reopening. However, there is still uncertainty regarding the sustainability of the recovery as countries are entering back into lockdown on new outbreaks. GDP is currently sitting at 2-decade highs, and although unemployment has fallen significantly to be sitting at 7.4%, near the pre-pandemic low of 7.1%, there is still significant slack in the labour market. This will allow for wages to grow, but not at robust rates. We need to free up travel so that some of those unemployed can fill those jobs historically filled by backpackers. Europe's recovery has underlying strength, but not necessarily convincing and long-term, with continuing accommodative policies into the near term, including the ECB's continued bond purchase program, in order to support Europe's long-term recovery. This is notwithstanding that the Bank of England has already commenced increasing interest rates and is targeting 4 rate rises in 2022. Indicators suggest that confidence is falling and affecting activity, with a reluctance on firms to borrow to invest in new capacity, and lending standards for new homes have tightened. Price pressures associated with supply chain disruption and soaring energy prices has pushed inflation to the highest levels since the EU's introduction, hurting confidence in the near-term outlook. Europe has benefited less during COVID compared to other regions as it is more tourism dependent. However, this should mean that it should benefit as the local economies reopen. It is more resilient to rising interest rates, it has more value stocks, while policies remain generally accommodative, providing significant income and growth support. This has meant that the equities market in Europe has a much stronger economic outlook compared to others because it is coming off a low base, although much of this may already have been priced in. As to the current opportunities, China's initial focus is the stabilisation of property developers and increasing growth, which over the short term will include the relaxation of restrictions on energy-intensive industries. This will then flow onto infrastructure and non-speculative housing. This will go some way to restoring demand for bulk commodities. Household savings rates are significantly higher than historical levels, with Australia currently at 19.8% compared to historical averages of circa 5%. The drawdown of savings will cushion the inevitable slowdown from the withdrawal of stimulus. As we have seen for the big lines at COVID testing centres, there is a rotation of spending from goods to experiential purchases, particularly those in the service sector, as well as retail that can really only be bought in-store rather than online. Travel, tourism and related businesses will benefit, while those that have benefited from online selling will underperform. Climate change discussions at COP26 focus the world's attention on the urgent need to address climate change and emissions targets for 2030 and 2050. This will see a transition away from reliance on hydrocarbon-based energy. Commodities such as lithium, nickel, copper, aluminium and rare earths will continue to see an increase in demand as we transition to a low-carbon future. Uranium will play a part, but has already seen a speculative price increase since it is generally sold on long-term contracts. Over the short term, however, reopening economies will see an increase in mobility, which will feed into short-term demand for oil. However, pricing will also depend on supply from OPEC, as the road to hell is paved with good intentions. Banks' margins are under pressure as interest rates are rising. This is opening the gate for restoring margins from continued fixed rate increases, but what I am waiting for is to see which of the Big Four cartel will be the first sacrifice in an out-of-cycle variable rate increase. However, the short-term threats are as follows. China is focusing on changing consumption habits to local brands. Those stocks exposed to Chinese consumption that have not already been sold down will continue to find it challenging as foreign sources of goods and services are replaced. This will not be just direct exposure, but also indirect. Inflation is a global issue, which is becoming more entrenched as demand continues to outstrip supply and households have built up significant amounts of savings. Throw in some government infrastructure spending programs to support growth, and this feeds into more inflation. Some of this is outside the control of the RBA, with delays by central banks to act to increase interest rates may require the need for more aggressive and disruptive responses later. COVID flare-ups is also creating uncertainty regarding the timing of the reversal of emergency settings, creating further supply-side risks and potentially putting further pressure on inflation. This is also raising uncertainty over improved mobility, which impacts travel, tourism and demand for oil. A structural shift in demand for hydrocarbons, particularly as a result of the focus created by COP26, climate change and emissions targets for 2030 and 2050, will see a long-term reduction for oil, but not straight away. Beijing's policy to crack down on excessive leverage and property speculation activities will reduce the demand for bulk commodities compared to previous cycles. It'll be a long time before we see iron ore at $230 and met coal at $300 again. The big one is bond proxies, and stocks that will generate income over an elongated time frame will be punished as interest rates increase. This includes high growth, high multiple tech stocks, as well as non-income producing tech, exploration and biotechs. The geopolitical tension between China and Australia is putting pressure on trade relations. Although iron ore might be the last bastion between Australia and China, they are seeking to diversify their supply sources. But it does not stop there. 2022 is expected to be a transitional year where the world tries to get off its stimulus addiction. With rising interest rates and falling growth rates, this is expected to put pressure on asset values, particularly in more sensitive sectors. As we have seen in the last couple of months, the market has been trading relatively flat. However, the underlying sectors are increasing in volatility with some big shifts between sectors. The overall market is fully priced, and currently there is no visible catalyst for further upside. The market is expected to trend sideways for the short term, with more downside risk than upside. Just remember the saying, past performance is not an indicator of future performance, and the same applies now. There is still a risk that there could be significant movements in the market, with bond proxies under pressure while companies exposed to China being mixed. Raising interest rates will put pressure on high multiple growth stocks such as the tech sector, but also other not yet generating income. However, there will still be upside opportunities for specific stocks, for example those that benefit from ongoing digitisation or decarbonisation. As interest rates increase, this is not expected to have an automatic feed-in impact into discount rates and ultimately security valuations, particularly since the rate tightening cycle is not expected to be as high as prior cycles. It will be a matter of working out which assets are overpriced and how to best take advantage of the ending of the long-term bull market. Investments need to be selective across both sectors and even within sectors. Well, that's it for this update, and thanks for bearing with me. However, as always, remember you can always stay up to date by following us on LinkedIn, Twitter or Facebook, or even checking out our website at agiliscapitalist.com.